Right now, the most valuable startup on Earth is losing more than $2 for every single dollar it makes. The 5 biggest tech companies on the planet are about to spend $725 billion in a single year on artificial intelligence. Sam Altman put it in writing. Are investors as a whole overexcited about AI? My opinion is yes. And on camera, he went even further.
And it is the people that are using these that are now seeing, incredible productivity growth, wage growth, all of the benefits from this. But I think people are right to be anxious.
Every tech bubble in history felt unstoppable, right up until the moment it wasn't. The dot-coms had the internet. Today, we have intelligence itself. But bubbles don't burst because the technology is fake. They burst because the math stops working. So here's the question this video answers. What happens if the AI bubble actually bursts? And why does OpenAI end up standing in exactly the wrong place? First, you need to understand how much money is actually moving. This year alone, Microsoft, Google, Amazon, Meta, and Oracle will spend over $700 billion on data centers and chips.
Amazon, Meta, and Microsoft projected combined spending of $610 billion for 2026, with
To picture the scale, that is more than the entire annual GDP of Singapore, 1 year, on buildings full of graphics cards. Nvidia, the company selling shovels in this gold rush, now books around $75 billion a quarter from data centers, at roughly 75% gross margins.
data center revenue in the fourth quarter reached a record $62.3 billion, up 75% from 1 year ago and making up over 91% of the company.
Total worldwide AI spending this year, $2.6 trillion, up 47% in 12 months. And the beating heart of all of it is one company, OpenAI. ChatGPT has around 900 million weekly users, and it triggered an arms race that has pulled in every major government and corporation on Earth. But here's where the story gets strange. Follow the money closely, and you'll notice something odd. It keeps coming back. In 2025, Nvidia announced up to $100 billion of investment into OpenAI, money that OpenAI would spend on Nvidia chips. Oracle signed a $300 billion compute deal with OpenAI, then turned around and spent $40 billion on Nvidia chips to service it. AMD handed OpenAI warrants for a slice of its shares, in exchange for buying AMD chips. Microsoft invests in OpenAI. OpenAI rents Microsoft Cloud. Amazon poured $50 billion into their last funding round. OpenAI rents Amazon servers. Economists have a name for money that travels in a circle: round-tripping. It's how dot-com companies once made their revenue look bigger than it was. Defenders call it vendor financing, the same thing General Motors does when it lends you money to buy a GM truck.
And selling from each other and also investing in each other. Take a simple example. Let's say
Both sides have a point, but if AI demand disappoints even slightly, every single company on this list gets hurt at once. So, is it a bubble? Don't take my word for it. Ask the people inside the machine.
Are we in an AI bubble? Of course, right? We were in that bubble. Of course we are. I mean, we're hyped, we're accelerating, we're putting enormous leverage into the system. That said, I don't see it ending for several years.
Of course we are. That's not a podcaster hunting clicks. That's the former chief executive of Intel. Even the Bank for International Settlements, the central bank of central banks, now warns the sector's net economic surplus could turn negative. And the Federal Reserve has reportedly flagged AI stock concentration as a top systemic risk.
This brings back nightmares from the pre-financial crisis and housing bubble.
Because here is the arithmetic that nobody in the middle of a boom wants to do. JP Morgan estimates the industry needs $650 billion of new annual revenue just to earn a 10% return on what's being built. Bain puts the requirement at $2 trillion a year by 2030. Actual AI revenue today, somewhere between 50 and 150 billion, even counting generously. That gap is, at best, 4 times too wide. At worst, 40, and it has to close in years, not decades. And the spending isn't even cash anymore. Moody's found $662 billion in data center leases, signed but not yet started, sitting off balance sheet. Amazon's free cash flow has gone negative. At some of these firms, capital spending now exceeds 100% of operating cash flow.
Investments. This brings back nightmares from the pre-financial crisis and housing bubble. But right now, for example, according to the Journal, you have big tech.
OpenAI just raised the largest private funding round in history, largely to pay bills it had already signed. Its commitments through 2030, $750 billion. By its own CFO's count. But here's the part almost everyone misses. When a bubble bursts, it doesn't hit everyone equally. It hits hardest wherever value is weakest. And for OpenAI, value is leaking out of the exact layer it occupies. Remember what happened the last time infrastructure ran ahead of demand? The dot-com era laid fiber optic networks worth a fraction of what they cost. WorldCom collapsed, Global Crossing collapsed, but the fiber stayed in the ground.
And the giant run-up that it did in '99 on the idea that Y2K was a giant permanent demand for
15 years later, that dead fiber became cheap bandwidth, the foundation of streaming, social media, and the entire modern internet. The technology won. The investors who bought the peak were still wiped out. AI is repeating the pattern, with a twist. The commodity being manufactured this time is intelligence itself. The price of a single token has fallen roughly 90% since 2023. 90% in 3 years. Open weight models now trail the best closed models by less than 2 points on standard benchmarks. When everything sounds the same, buyers stop paying premiums. Altman himself predicted this, writing that the cost of intelligence should eventually converge toward the cost of electricity. Think about what he just admitted. The product his company sells is headed toward utility pricing. And utilities are fine businesses. Regulated, boring, thin margins. Nobody becomes a trillionaire selling electricity. The fortunes get made one layer over, by whoever owns what electricity unlocks. So where is the value going? Down the stack, into silicon, power, and data centers. The physical stuff that is genuinely scarce. That's why Nvidia charges 75% margins, while the model builders above it lose money on every query. Nvidia owns scarcity. OpenAI owns a product that is commoditizing under its feet. Go up the stack, same squeeze. AI apps carry lower margins than ordinary software. Amazon is already quietly cutting back its own Nova models. The app layer isn't where the money lives either. OpenAI is trapped in the middle. Too far upstream to own the customer, like Apple or Google, too far downstream to own the silicon, like Nvidia. So what actually pops it? Bubbles rarely die from one big explosion, they die from a chain reaction of small doubts. Trigger 1. Revenue growth flattens. OpenAI's run rate stalled near $25 billion earlier this year. If growth bends while commitments stay fixed, the math breaks fast. Trigger 2. Depreciation wakes up. Chips wear out faster than the revenue they produce. Shorten GPU lifespan assumptions from 5 years to 3, and the cost of running this industry jumps over 40% overnight. Trigger 3. Credit. This cycle has started leaning on debt. GPU-backed loans, private credit, off-balance sheet leases. Leverage turns a slowdown into a stampede.
There's a lot of leverage in the system. There's a lot of cash, but then there's a whole bunch of other folks who are trying to build these data centers, and whether there's the energy component side of it, or whether you think about the real estate.
Trigger 4. One high-profile failure. One bankruptcy, one scandal, one missed quarter from Nvidia. And every circular promise in that web gets repriced at the same instant. If it happens, here's what the bust looks like. Model companies consolidate or die. Data center construction halts mid-build. Around 40% of planned US data centers are already delayed. The 5 hyperscalers make up roughly a third of the entire S&P 500, so a burst lands directly in retirement accounts, not just Silicon Valley. And yet, the technology survives, just like the internet survived. Cheap tokens become plumbing for real products, and the next generation of great companies gets built on the wreckage. So, will it burst? Here's my honest read. Something is definitely inflated. The financing, the commitments, the promises stacked against revenue that hasn't arrived yet. Whether that's a balloon or a landing depends on one thing: whether A, revenue can grow more than 6-fold by 2030. That's the bank's break-even math, not mine. Sam Altman believes his company is worth more than $1 trillion, which means his own math requires him to never be wrong about the future. History's lesson is simple. When smart people get overexcited about a kernel of truth, the truth wins eventually. The excitement doesn't. If you want the other side of this story, the case that this time is different, that video is on screen now. Subscribe for the follow-up when the numbers land. Thanks for watching.